Welcome to the dashboards and screens from Friday, March the 5th for Monday, March the 8th, 2021. So some notes here. This training was done live before March the 8th. You may be consuming this education after that date, but once you learn how to gather ideas and trade with strategic orders, you can repeat this process day after day. Dashboards, web screener, and calling the data through the API all serve to assist traders in planning for the next time frame they choose. Being armed with information is part of trading as a business. Having knowledge and wisdom on what to do with the data is another. Taking time to frame the trades and create rules for entry and exit. Operating with discipline. And maintaining perspective and managing emotions. So here's a dashboard that we did for, this was basically after the close on March the 5th, when the data is updated. And we looked at this for our projected returns for Monday and subsequently. So this is projected 3-day returns. And we focus on the trending up category here. So let's look at Wayfair and Cliff. And we see that the RSI value we have at 50 and 54. The subsequent odds of it being up for the next time frame, which is again a 3-day projected return, is 55.6 for Cliff with a average percent change of 1.55%. And for Wayfair, it's 60.3 odds of being up with a 1.61% average change. We also look at Vail. Odds are 51.5, so not super fantastic, but the performance 1.04%. And for Netflix, 62.6 on the odds and 0.92% return projected for the 3 days. So this gives us some bullish ideas, some going long ideas. We could also look at the bullish reversals area for some ideas. These are things that have reversed recently. And this is some of the ones that started to roll over and trend down, and some bearish reversals. We also look at Skyworks here, and we've got 63.9% chance of being up with an average performance of 1.10. So let's look at some charts here. We believe in looking at things as a whole package. You know, this is the quantitative side. You know, what's the data say? What does a chart look like? What's the context of the market? You know, is there any news, any fundamental changes? So the best to look at things as a package, but here we see what happened on Friday was this reversal here. The stock made a new low relative to the day before, and then actually 1, 2, 3, 4, 5. So this made a new 5-day low as well, but rejected it, moved higher and closed higher. So we're looking for some follow through to that rejection of a new low. We're looking for some follow through to this closing above the previous day's high. So it closed above Thursday's high. So looking for some follow through. That's what our numbers are saying, that the odds are favorable for the next 3 days. As the market reversed on Friday, in sympathy, most stocks would have sold off and reversed when the market reversed. Cleveland Cliffs, same thing, new low. This is actually not just a 5-day new low, 10, 20, and more. I mean, this is a significant penetration into a new low, but it did reverse and close higher, similar to the Wayfair. Very different price in the two stocks, but similar price action. So let's see the daily chart for the SPY for the 1 year. Now, what we see here is a whole bunch of pullbacks along the way, just like we had on Thursday and Friday, but then Friday rejected and moved higher. But all of these have something in common. You notice it? All are higher lows. So since the March 23rd discount that we had, substantial correction, market correction due to COVID, we rebuilt off of that, and all of these pullbacks have been higher lows along the way. So here's the daily chart on a tighter time frame here, looking at what happened on Thursday and Friday. Now this is a little different than those other stocks. This did not make a new low relative to Thursday, but we have the same rejection of that discount, moving higher and closing substantially higher. So buyers did come in on that Friday and drove it up, and the close was quite substantial. Okay, did not make a new low relative to the previous day. Thoughts? So SPY failed to make a new low relative to the previous day or the 5, 10, or 20-day lows. SPY has a beta of 1. And Wayfair, looking at its beta, we like to calculate things a little bit more detailed than what you would find with, say, beta presented on Yahoo Finance or FinBiz or other places. Yahoo is based on a 36-month, 3 years basically is the beta. And ours is calculated over numerous time frames. So there's 2 of the shorter term time frames, a 20-day and a 65-day. And we like to look at the average beta, but also the up beta and down beta. How does it move when it moves up relative to the S&P? How does it move when it moves down relative to the S&P? So a beta of 1.5 forecasts a 1.5% change in the return on an asset for every 1% change in the return on the market. So this would mean that, let's focus on this 65-day beta right here. If the market moved up 1%, Wayfair should move up 1.52%. Cleveland Cliffs. If the market moved up 1%, it should move up 2.34% on average. Now, we look at it and go, okay, what does it really look like on the up versus down? And you can see here that it's a little bit reluctant to move up that much on an up move, and certainly moves more to the downside on a down move. So the average is actually misleading, which is why when you take just one number and say, okay, what's a 3-year beta, that it doesn't really tell the whole story. So we like to look at things, and this data is available inside our database as well for your consumption and utilization. Normally, beta is calculated as 1 year or 3 years. This can be quite lagging. I like to see it calculated in shorter time frames. Additionally, it's interesting to examine the up beta versus the down beta. This is how it moves relative to the S&P 500 on days when stocks go up versus on days when stocks go down. And high beta stocks are best to own in a strong bull market, but are worse to own in a bear market. So when we start to get into a correction, remember that you're going to feel it. High beta stocks will definitely go down more than the market. Okay, which is actually what we saw in our charts. We saw the SPY did not make a new low relative to Thursday, but the stocks actually did. They moved more to the downside. And subsequently, when things turned around, they could also move more to the upside. And if the market has follow through, then we could see them continue to move higher and give you that performance over just a beta of 1, because their betas are higher. Skyworks, same thing, new low, and we can see the beta down here. So this is pretty much in line. It's more, similar in the up and down days. But basically, the market moves up 1%. This should move up 2%. Netflix, not quite as aggressive. If the market moves up a little bit less than 2% or 1%, this will move up less than 2%. And then Vale is more benign, 1.27 on the average, 1.3 an up day, a little bit more on a down day. And we can see from this chart that it's a little bit different than the other ones. This one started down, it actually gapped down, and then it proceeded to kind of move up all day, whereas these went down, made new lows, and then reversed and went up. So Vale showed a little bit stronger for the Friday price action there. So these ones here, now they're not green candles for Friday. So they did have reversals, but they did not close as strong. So they didn't close higher than the previous day's close. They closed lower than the previous day's close, both of them. They rallied, but they failed near the end of the day there. So these stocks are showing a red candle for Friday's action, while previous symbols showed a green candle. How can we know which type of candle will perform? Well, we don't. We don't know if this one will perform better than the other one. We have to look at our data. So all we can do is go with the odds, the performance, and the sharp stats and see what is more probable of occurring on Monday. See, everything from our database is a signal and the subsequent performance for the selected time frame, whether that's open to close, close to close, overnight returns, or could be 3 days, 5 days, weekly, monthly. So we get to choose our output time frame, and we want to know what the subsequent performance is. So the TDOC and DOC came from this bullish reversals, where before we had selected from the trending up. And so they show 61.8% odds of being up for TDOC, 2.84% performance, so very substantial there. And DOCU would be 62.9 for 2.79%. So that's where that came from. So in the Bollinger Band report, so that was an RSI2 report that we were looking at with subsequent performance for 3 days following the signal. This is percent Bollinger Band. This is the penetration of the Bollinger Band, which by default are +2 and -2 standard deviations. So we want to know what happens after that penetration of whatever magnitude it is. It will all be categorized into bins. And so where it falls into that bin, it says, hey, last time it did this, this is what happened. And looking at some of our trending up ones, we see that there's some similar symbols on the Bollinger Band report as were on the RSI2 report. So you see Wayfair shows up again and Vale shows up again. We also have some other ones to look at as well. So this means there could be sustained traction beyond just Monday open to close. We could see the 3-day return kicking in. We could see as much as 10-day return kicking in on some of these symbols. When you're using the dashboards, you get to choose the volume through the sliders and the price and the number of events. We've set it up, pretty static, standardized for you. Usually the volume is about 150 in terms of millions of dollars of turnover. But you can play around, and the higher the volume, the more large cap household name stuff you're going to see. The lower the volume, you're going to see a lot of smaller market cap, less widely known stocks, things like that. So again, on this one, we see Wayfair and Vale are common to this Bollinger Band report, as we saw them also in the RSI2 report. Picking up from that, we'll look at the DraftKings and Uber from this report as well. So we have DraftKings, there's the daily chart. Look at how that's been trending up with a pullback to the trend line, right? So what are we seeing here with the odds? 76.5% chance of being up for a performance of 6.72% after this penetration of the Bollinger Band down at 0.31 penetration. So this looks pretty exciting for the DraftKings. But the interesting thing is the chart is one of those red candles, right? It didn't do that complete reversal where it closed higher than the previous day. So people are making a lot of assumptions from charts going, oh, I'm not interested in that one. It didn't close like this. It didn't perform like that. And you got to dig more into the quantitative side to get, your bearing. So I like the fact that, hey, we have a trend line. It pulled back to the trend line and it did reject that and close a bit higher, but it certainly wasn't a bullish candle in the sense of closing above the previous day's close. But our odds look good. Our performance metrics look good. So could be a great trade. So significant drop of recent highs, pulled back to its trend line, bounced with the market bounce, but did not close at a high or above the previous day's close like some previous symbols we looked at. Here's the Uber one. Now this one, you see that it was more in a consolidation area prior to Friday's action. So it's certainly not had that big drop that DraftKings did. It was channeling more sideways, probably in a pretty fair value area. And it did drop with the market and it rejected and closed higher with a green candle, being that it closed above Thursday's close. So it did close higher than it opened, unlike the DraftKings. Okay, now this is a screen that I ran from our web screener, and I'm specifically looking at what happened on Friday in terms of price performance move. Like, how did it actually perform? And then what bin of performance did that fall into? And what was the subsequent odds and average performance and sharp expected from that? So on average, what would happen or is likely to happen, or as we call this, predictive analytics, what is predicted to happen on average after that event, okay? So this will be for Monday's open to close. You could put them on at the open, take them off at the close, not touch them all day. That kind of opportunity is presented here. Now, I'm not an analyst. I'm not recommending. I'm not advising. I'm not an advisor. I don't handle wealth management or anything like that. This is simply the statistics that are in the database. It's being presented. It's for our subscribers to consume and to utilize. And we always recommend doing some long ideas and short ideas. We'll talk about that a little bit later. So Clorox fell into the 3 to 3.25 price bin, odds being up 100%. So obviously kind of price to perfection with that kind of price move. There's only been, in the look back period that I chose, which was 2,000 days, there's only been 5 times it had that type of move. And the subsequent performance from that was 1.64%, just simply for the one day open to close. And the Sharpe ratio, very substantial, very positive at 5.07. So this is your risk-adjusted rate of return. Looking at last performance was very good, which is what we saw for the last event. The last close, that's the price, volume's healthy. And the maximum favorable excursion, 1.81, maximum adverse excursion, minus 1.31. So this is how much it goes, in your favor during these average events versus how much it can go against you. And I like to see a little healthier favorable excursion than adverse excursion. So as we get down the list here, the odds are less, but still healthy, and some of the events have had more samples. So for example, Kellogg's has had 15 events in the look back period, right? So, you might want to give more weight to something that's had more events, more samples, right? But performance-wise, you're not going to argue with something like Clorox. All the other numbers, even though it's had less events, all the other numbers are looking very, very attractive. So let's look at some charts here. Here's Clorox. This is Friday's move. Hardly a pullback. Blasted up pretty well here on Friday, March the 5th. Ignore this is the first, so that's the 5th there. PHM did not make a new low relative to Thursday. Neither did UNP, and neither did NSC. So the trains are looking pretty strong. So all this group here looks pretty attractive. I just pulled it off that list. So we're not, sort of selecting just the perfect ones. We just pulled it right from here, the first 4 of these, and that's what we see. Moving on, EFX, that's looking good. We had pretty much matching lows with Thursday, but Friday, very strong day. AT&T, not sure what's going on there, but really strong, coming up almost into a resistance area. So I'd be a little bit more cautious on that after such a stellar performance for 1, 2, 3, 4 days and up into resistance. CME is kind of breaking out to a new high in this last time frame that we see here. And it's showcasing itself pretty strong, so I might get some follow through on that one. Holix is one of those that did make a new low relative to Thursday and rejected it and closed higher. Kellogg's had some good support right down in here and turning the corner and blasting off on Friday, bucking the trend from what most other stocks did, which was fall significantly and then reverse. And now, I don't know what's happened with now, but it's broken a trend line, and I'm not super interested. Very expensive stock, and it was lower on our total list here. Only 73.4 or 0.2 odds of being up. Performance wasn't fantastic for open to close compared to some of these other ones. So maybe not the perfect fit for us when you combine this free look here at what's happened, but it is discounted. It did reject a new low, but it just didn't close super strong. There could be some follow through on that as well. The thing with doing a basket of stocks is if you keep your size low per idea and you do a lot of ideas, it would be hard for you out of a list of 10 stocks or 20 stocks or 30 stocks to pick the right one. You're more likely to find the right one because you did a number of stocks. So in a sense, let the market figure it out for you, and in that case, I would be willing to take the now as part of the, basket that I do. And I'm obviously going to adjust my size so that it's more similar per idea rather than having a lot of exposure to that stock and very little exposure to this stock. You want to have similar exposure in dollars and possibly in volatility amongst the stocks that you choose. Executing on the opportunity. Armed with information, it is important to trade correctly. If you have projections for 3 days or 10 days, then you might be more patient than scrambling right out of the gate on day 1. If you have projections for open to close for the next day, the time frame is obviously tighter. It is critical to place orders so that you are adequately compensated for risk being taken. Anytime you have an order working, it is at risk even before it's filled. When you have that live order in the market, you still haven't been filled, but it's still at risk because a news item could come along and it could just run over you and you haven't had time to cancel, that kind of thing. So all orders that are working are at risk, just like orders that are already completed. If you want to buy symbol T, you may be at risk for buying it at resistance, but waiting to see if it can break above may be better. So that one we discussed there with the multi-day resistant, you probably are at risk with that. Symbol EFX, it has a lot less resistance and is breaking up from support, so that could be more attractive than T. Again, you can still pick and choose your symbols. All I'm saying before is it's going to be tough to pick the perfectly right 1 out of 10. You're much better to say, I've got 10 that I like, 8 of them is what I kind of feel comfortable working, 2 of them I'll ignore. You're still going to have a better chance of having some good trades in there. But when you get trying to select only the 1 symbol out of 10, it's going to be tough. So you could establish a position pre-market at open during the day session or in the extended hours trading session. So When you have a longer time frame, you say, you know, I've got 3 days or 10 days to deal with this. You know, be selective. You don't have to trade them all right out of the gate, but you can, right? Pre-market and extended hours trading has more risk because there's no price protection. Stocks can be thinly traded. Bid-ask spreads can be significant. News can come along and you won't be able to get out of the way in time. So having a probability for a trade still means executing at a price that is advantaged and not a gamble. One has to take into account where the overall market closed and what is being indicated in the overnight and pre-market session. This can guide you on order placement for the open. Here's an example of adjusting for market and performance. A very simple approach is just to look at how much the implied open indicates. So if you went to CNBC pre-markets, you could find what's indicated. So if we're going to open up 0.7%, then you could factor that in against your stock's previous close. This would mean that you are willing to place orders above. So let's look at the implied open from CNBC pre-markets. So that's the implied open is 28.81 points above the close. So the future is trading above the cash close and is fair value adjusted. So it tells you the implied open. You can use that as a multiplier against your last price of your stock. So basically, if we were looking at Clorox, that would mean that you could buy at $1.30 above the previous close. So let's look at that here. It closed at $184.34. So times roughly 0.7%, we're looking at $1.30. So you could be willing to buy up above that previous close by as much as $1.30, and that would be considered still fair value for that stock for that day. So Clorox could be purchased higher than it closed, and you'd still be in keeping with what the market's doing. So another aspect is we're expecting an average type performance of 1.65%, right? So here's our average performance. That's what we're expecting to happen open to close on average after this type of event, which was the price move falling into that particular bin, 3% to 3.25% performance. It's only happened 5 times, as we mentioned, in the look back period of 2,000 days. And the average performance on open to close is 1.64%. So I could factor that in as well. So if we add that to the market premium, we have around 2%, right? Therefore, we could pay up 30 to 50% of that total for our limit order at the open. Okay, so this kind of helps you get involved in placing an order that's not a market order, it's a limit order. A market order would mean that you're willing to pay anything, and it could really gap up on you and cause a big problem. A limit order means you're controlling your risk. So I'd be willing to put my order up maybe as much as 1% to be really aggressive, and I would still be in keeping with the market change, what the implied open is telling me, as well as factoring in a little bit of performance, okay? What did happen? So I'm adding a post review here. Below you can see that the Clorox had the follow through from Friday to Monday. So we had looked at Friday. Now this is Monday. Well, what did it do? Friday, this is the after hours and pre-market, and this is Monday. According to the implied open and our performance expectation, we should have been willing to pay up at least 1% above the previous close. So there's the previous close. This is what happened after hours, and then here's pre-market. It looks like someone is paying up pre-market already. So the expectation is running high. Somebody's sticking their neck out and paying up. But what happened? It opened down below. Here's where it opened, below the previous close. So if you had your order in here as a limit order, say up 1%, being willing to say, I'm willing to pay a bit of premium, you would have been even higher, but you wouldn't have been filled because an open order is only for the opening auction and will not be filled before that. So you get to participate in the opening auction. The designated market maker's job is to provide a fair and balanced approach for that open by mingling the buyers and the sellers. And apparently there was more sellers for some reason. Maybe they're not watching the information that we have. There was more sellers at the open, and it opened down. And your open limit order gets filled at your price or better in that auction. And so you would have been filled right here. Now, it's possible that some people that bought it at the open might have been scared out with the drop afterwards. But remember, we as basket traders are trading open to close with small size per idea. You're not going to get shaken out if you do small size per idea. If you do too much size, you're probably going to get caught up in the fear and all that kind of thing too. We choose the price of our participation. We don't have to get shaken out of a trade. We can hedge market risk by doing some long trades as well as some short trades. Summary. The dashboards and web screener reveal the probabilities of outcome but offer no guarantee. It is important to trade with the correct expectation, allowances, and parameters considering risk-adjusted returns. It is also recommended to have some long ideas and short ideas to take advantage of relative performance, not having to be right on the overall market direction. Most stocks are moving with the market, so depending on their betas and historical volatility, they will move in line or more or less than the market. You can trade any time frame of your choosing or overlay strategies that have different time considerations. Do not just focus on odds, but look at the metrics as a whole. Are the performance and Sharpe ratios positive for a long trade? Conversely, if you were doing a short trade, you might want to look for negative numbers, something that showcases that it's inclined to go down. It doesn't perform very well. It doesn't have a great risk-adjusted return. Those are better for shorts. So thank you for watching and consuming this education. Contact us if you have any questions.